let's bring it together into a portfolio. So, because obviously, practically speaking, what do you need to know this for? You need to buy bonds, make a portfolio of bonds, and you need to worry about if interest rate risk is going to destroy your portfolio, right? If interest rates are expected to go up, that means your bonds will come down in price, which means your portfolio will come down in price. So you need to know what is the duration and convexity of your portfolio. Now, from the perspective of the exam, what you need to know is that there are two ways of going about doing this. One way is that, let's say, if you have a two bond portfolio, which one of them is giving you, let's say, $50, and 1,000 at the end, and they're both maturing in 2 years. The other one is giving you 60 and then 1,000, right? So you could just aggregate the cash flows, which means this would become what, 110, this would become 2,110, right? And based on that aggregated cash flows, you could calculate the MACD, right? Weighted average number of years till you get your money back. And then based on that, you could calculate the mod D of the entire portfolio. So that is theoretically the best way of going about this. But it's a very lengthy way, right? So there is a easy way to do it where you could just take the durations and the convexities of each of those individual bonds, and then just depending on how much money you have in each of the bonds as a percentage of your total portfolio value, right? So the weighted average. So you take the weights of each of the bond and just multiply it with the duration and the convexity to calculate the weighted average of the duration and convexity. So that is easy to do, and therefore it is commonly used in practice. But there is a problem here. Now, what the problem is, and coming back to our understanding of the yield curve with different maturities, let's say this is 5 year, 10 year, 15, 20, right, 30, and so on. The yield curve usually looks like this, but it changes. And it's not always, well, it's never really, hardly ever a parallel shift like this, that if the yield is going up, the yield for all maturities is going up exactly the same, or if it's coming down, the yield for all maturities is coming down exactly the same. Usually, practically speaking, what we have are maybe the long end is going up, or maybe the short end is going up, right? Or maybe you have something called a butterfly shift where the middle end is changing. But we'll talk about that separately. What you need to understand right now is that parallel shifts seldom happen, right? But your weighted average assumes a parallel shift. Because why? Let me explain to you why. See, you're not really adding the cash flows together. If you're not adding the cash flows together, you are not really capturing that year wise cash flow. So if only the 10-year rate were to change, right? Or if only, let's say, the 5-year rate were to change, the short end of the curve was going up, that means it would only impact the those cash flows which are in that 5-year period, right? But since you're not adding the cash flows, and you're just ignoring the separate cash flows, and you're just taking a weighted average of the durations and convexities, therefore you don't have that input of year wise cash flow, and this weighted average of duration and convexity only works with parallel shift. So this is the limitation. But then again, it's easy to use, and therefore it's commonly used. The aggregated cash flows method is obviously theoretically correct, but difficult to use in practice. So that's the main point over here. Now, let's apply this concept in terms of a numerical and also in terms of an analysis, right? So, this is a very nice question actually, and this is coming from your curriculum. And let me walk you through the question before you try to do it. Because, I mean, the first part is very, very simple. Calculate the weighted average duration and convexity. Obviously, you have the weights, you have the duration and convexity. So, this is a very easy thing for you to do. You just have to multiply the weights with the duration and convexity. Second part is also easy to do, because for the current portfolio, all you have to do is take out the added US Treasury amount, right? And calculate the weights again based on what they would have been, and then calculate the weighted average duration and convexity based on that, and then compare. Now this is where I want to see your analyst hat coming on, that you compare the two convexity and duration of the portfolio, the current portfolio versus the proposed portfolio, and see if that interest rates are expected to go down, right? If interest rates are expected to go down, have they done a good job by including the US treasuries or not, right? That is where I want you to see. I want to see your analyst hat coming up, where they are considering adding 10-year US treasuries to this portfolio, right? And this is what the weight would be after they add. So I want you to calculate the weighted average duration and convexity of the current portfolio and the proposed portfolio, compare the two, and then recommend whether they should be added or not, assuming that interest rates are about to go down, expected to go down by 1% or 100 basis points. Right. So hopefully you were able to calculate this first part, which is very simple. All you have to do is you have to take the weight of each, take the duration of each, right? So this is where the weight is coming, duration is coming, then the weight is coming, duration is coming, and then weight is coming, and duration is coming, and you get the weighted average duration. Similarly, the same thing for the convexity. And if you want to calculate for the current portfolio, obviously that is done by assuming that the US treasuries would not have been added. And then you see that the duration is going down and the convexity is also going down, right? And why is that happening? So let me just take you back. Obviously, it is happening because you're adding US treasuries, which is lower convexity and lower duration compared to the Romanian ones. So it is pulling that average down, right? Even though your BRWA is even lower than the US ones, right? It's even lower than the US ones, but still the US ones are lesser than this one. So the average, it's being pulled to the middle. And that's, so far it's easy to do. But now the third one, where the interest rate is expected to go down, what would you do? So let me just pause here for a minute. And even though if you haven't solved the third one, before I show you the answer, what do you think? By adding your US Treasury, you have actually decreased the duration and convexity. Now, a lower duration, is that good or bad if your interest rate is expected to go down? Yes, you are absolutely right. That is bad, right? So now, if interest rate is expected to go down, what will happen is that your interest rate is expected to go down, your bond prices will go up. Now, because of a lower duration and a lower convexity, you would not gain that much if you had not added the duration, the US treasuries. Your duration would have been higher, your convexity would have been higher, and your bond would have probably gone up a lot more, right? Your portfolio value would have gone up a lot more. So this is the thing. This is where it all comes together, that all of this analysis that we are doing, the core is having an expectation of where we are headed in terms of interest rates. And that's where your economics material becomes so relevant, right? I mean, where you are in the business cycle, what's inflation doing, what are the leading indicators showing you. So that really helps you figure out what the Federal Reserve will do. And practically speaking, then that makes a huge impact on what we should be doing in our portfolios. So this is the theory, and this is why CFA is teaching you all of this, that how do you calculate duration and convexity of a bond, then how do you put it together for a portfolio, and then how do you position yourself within the portfolio depending on what you are expecting in terms of the monetary policy actions of the Fed, based on what you think is going on in the economic factors and the leading indicators. So this is where it's all coming together, and I hope you're enjoying this. Right. So here's the summary of this learning module. That number one, we talked about the changes in price of a bond being non-linear, right? There's a convexity there, and we need to have a convexity adjustment for that. We looked at how do we go about doing that. So we obviously take the duration adjustment like we have been doing previously in previous learning modules, but then there is now also the convexity adjustment that needs to be done, and that is always a positive adjustment because the price goes up more and it doesn't come down that much because of convexity. So it is always a positive adjustment. Right, and then for the portfolio, we talked about the two ways of doing it, one being the more theoretically correct way, but difficult to do, takes a lot of time. So the easier way of the weighted average of the duration and convexity. But here, it assumes that you are having a parallel shift of the yield curve, which seldom happens in reality. So that is it, my friends, and hopefully you enjoyed this learning module. As always, go to your CFA Institute learning ecosystem, click on practice. You have to go to candidate resources and then click on practice in the top left menu and go to this reading and solve as many questions as you can. And of course, we also have some questions available for you in the question bank. So best of luck, guys, and hope to see you in the next learning module.